Welcome back to Accrued Interest. I'm going to go over Fubo TV's Q1 2025 earnings just released on Friday. The information presented in this podcast is not and should not be construed as investment advice. Investors should make their own decisions regarding the prospects of any company discussed on the show. I do not own any shares of Fubo TV, nor am I short. I am just a media analyst that likes to talk about stocks. Management led with the positives, focusing on the fact that they achieved their revenue targets for Q1 2025. I want to focus on the fact that the subscriber base is shrinking, the business is not doing well. It makes a lot of sense why the stock is currently down about 24% over the last 5 days. It's becoming increasingly clear that streaming alternatives to conventional cable TV are facing the same marketability problems old school TV was facing. I like to go over some key performance indicators that the company shared on their Q1 earnings. North American subscribers fell 3%. Television is a fixed cost business. They cannot cut costs that much when they lose a subscriber. Making matters even worse, North American subscribers were previously growing for the last 4 quarters. The growth that they did get from revenue, that came entirely from pricing. Getting more revenue out of fewer customers is a bad business proposition. Before we get to the international segment, I want to clear up one misconception. Fubo only has service in Canada and parts of Spain. This is not international play. There is no growth from international. In fact, it is declining even faster than North American business. International subscribers were down 11%. 2Q guidance was very poor. If you take the midpoint for North American subscribers, management is forecasting a 14% decline year over year. The business had many weak excuses for their shortfalls. Fubo TV was down about 17% in Q1 2025 in advertising revenue. They lost subscribers from Televisa Univision when they dropped their channels. The company should have been able to find growth in other parts of their business. Bulls like to hold on to the fact they are going to get some content savings after they do the deal with Disney. I'm here to tell you that cost savings do not matter when revenue is shrinking. Fubo bulls are mad at me for pointing out these operational issues. The reason why the stock is down is because more and more investors are seeing the merger with Hulu is not necessarily going to save the company. I encourage you to go back to my YouTube page. Many of the issues that the company had in Q1 I raised in past videos. Last time, we also looked at the fourth quarter earnings, which were also not good. And then in my last 2 videos, I analyzed the upside case. I argued that using management's optimistic forecast, the best outcome you could expect was anywhere between $3 to $5 a share. If you assume the 10.5 times EV to EBITDA multiple, the full market multiple that Disney currently gets, at most, the stock would be worth about $3.27. It was very odd that both the CEO and the CFO were in the open market selling between $4 and $5 a share. The next key date, Wednesday, May 7th, when Disney releases their Q1 earnings. Hulu Live TV is currently stuck at about 4.6 million subscribers. Also, while management has been forecasting that they think they can get to 10% revenue growth, Hulu's live sub only grew 5% total in the last 2 years. I'm going to tune into the Disney earnings, but right now I'm still wondering, where is this 10% top-line revenue growth expected to come from? As always, thank you for listening. If you enjoyed this deep dive, don't forget to subscribe to the channel and subscribe to my Substack for more updates during Q1 earnings season.